Hello and welcome to the CNBC Africa Special. I'm Arnold Segoa. In the year 2000, to be more precise, May, The Economist, that's the magazine, did have a front page saying Africa, the helpless continent. Fast forward to where we are right now in 2017, the continent is growing north of 5%, and between 2000 to 2010, the continent had an annual average GDP growth of north of 5.4%. What has changed? Sectors like the hotel sector, to be more precise, that is as a subsector, have been adding to the GDP of the continent, and you have the likes of Rwanda, Ethiopia, Kenya, Cote d'Ivoire, all growing north of 6% annually. The hospitality industry in the region has gained recognition from the World Travel Awards. This serves as the best networking opportunity in the travel industry and the platform for Rwanda and East Africa to earn a seat in the world's hospitality industry on the back of their products and services.
It really affirms quality services, and also the fact that it's the World Travel Award, it's a very good marketing tool for us as in Kringo in the Gorilla Lodge. And how the award is selected, it's really credible because it's mostly the agents, the travel agents that are voting, and also the customers that have experienced the award. And in Uganda, we have been the leading lodge on TripAdvisor for the last 10 years. So winning this in the road just affirms that our service is really good. I think what people have to realize is that people now have niche. It's called a niche product. People are looking for specific things. People are looking for either to see birds, people are looking to go whitewater rafting. So people are becoming more specific on what they're looking out for. So to create yourself and put yourself out there in the market, you need to find a niche that people are looking out for. And that is why they're now awarding those niche products. Because this is what now people are looking for. People are looking to just go out and enjoy maybe a spa out of Africa on a beach somewhere, which is not be the case. Before, safaris were get into the vehicle, drive into the parks, and go back.
Some of the restaurants in the country have realized growth and as a result are committed to the market and looking forward to greater opportunities.
Heaven Restaurant's been around for 9 years, and we started as a restaurant, and then over the last 3 years, I'd say, we've grown into also a boutique hotel. So Heaven has 22 rooms. We provide a really nice service, and a lot of people are very happy with it. But my husband and I also see a need and a niche for luxury, and this is even before we knew that guerrilla permits would be increased and that there really was a drive to have the luxury client in Rwanda. We had made architectural plans and a dream to build the retreat. And the retreat is opening next month. It's our newest property, just next door to the restaurant. And really what we have built is something unique in Kigali, period. In the Gorillas region, in Nyungwe, you have the one and only, you have Bisate, you have all these luxury properties coming out, which is great. But when you land in Kigali, you've got large hotels and very, very small guest houses, but nothing that just suits the boutique, the small, the local experience. We have built something that is eco-friendly. It's 100% solar powered. We have invested in extremely unique finishes such as a saltwater, solar heated pool, a jacuzzi, a sauna. So in addition to having a very local experience, very small experience, only 11 rooms at the retreat, we want to take care of the business travelers and the tourists who are looking to have a more intimate experience. If you're interested in culinary, we'll take you on a tour of the markets. We'll have a private cooking class in our kitchen. If you're interested in the coffee sector, we'll take you out to a farm to spend a day with the coffee farmers. So we're really looking at designing unique experiences and taking care of each and every guest that comes through the retreat in a way that may not exist yet in Kigali. We're excited for this challenge.
With air transport in East Africa growing close to 12% in 2017 alone, and more infrastructure, hotels, and travel facilities, the tourism industry has experienced growth but hasn't yet achieved domestic tourism goals that it set out.
I think it's only in Uganda and Rwanda, Tanzania, that we're not getting domestic. Kenya has really proven, because yesterday I was meeting someone from a travel agency in Kenya, and was telling me they're very swamped with domestic tourism. So it's, I think, people realizing that this is their country. There is a lot, and it's not just the stories we used to hear as kids that once upon a time, and the things are there. The lions are there. People should be told these are not just long time ago stories. Go out and see. It's all about information. So with Kenya realizing that they have these things and they have been promoted by their own tourism boards, people are going out to visit their parks. And I believe for Rwanda and Uganda it can be the same. Domestic tourism can be promoted. It's information. Yeah. We're going to find that you find someone in Rwanda who has not even heard about Kampala. It's lack of information. So everyone is comfortable in their zones. I'm in South Africa and this is good for me. It's information sharing. To say that Africa is a big continent, the 52 countries out there, we need to explore them. I think it's the information sharing. All the boards should be advertising to African countries about the other African countries.
Most tourists who visit Rwanda have interests in local experiences, as argued by hoteliers, and this has pushed hotels and restaurant owners to introduce new Afrocentric cuisine.
What we've done 6 months ago is to create a modern African cuisine. We're taking influences from Mozambique, Kenya, Tanzania, Uganda, South Africa, and you'll find Zanzibar tagliatelle on our menu. It's a homemade pasta, but with flavors from Zanzibar. We have a kukupaka dish, which is a Swahili dish. So we're showing the beauty of not just Rwanda, but the continent. I think when people come to Rwanda, they want to eat what's local, and we're expanding to even include other countries on the continent on our menu. In addition to that, I believe that people should be spending more than one night, more than the first and last night in Kigali. You know, there is so much to see and do now in Kigali. The gorillas and safari are beautiful, but within Kigali, there are bustling cafes and shops. There are fashion designers making incredible African fabric clothing. There are amazing cooperatives you can visit, such as the Nyamirambo Women's Center. You can take a walking tour with the women who make the products in the cooperative, have a very personal experience with them. So I believe that we really need to start promoting Kigali as a destination, as well as the safari, the gorillas, and the chimpanzees. There's a lot to see and do now in the city. The new convention center is marvelous. The Kigali Heights Mall, there's just so much to see and do.
On my right, we do have David Happer, CEO of the Hotel Property Group Africa. Right next to him, that's on my right, we do have Daniel Silk, Director for Political Futures Consulting. And to my extreme right, last but not least, Amos Wekesa, the CEO and founder for Great Lakes Safaris. Good to have you, gentlemen. Now, Daniel, I just want to start this one off with you, because looking at the macros, Sub-Saharan Africa has been growing, even regardless of the slowdown that we did have with South Africa and Nigeria, all slowing down relatively for 2016. The region has been growing very substantially. And I want you to just give us a sense of the macros. What would you say, away from the commodities binge, what would you say has been driving this direction, and more particularly so maybe on the hotel space?
Well, look, I think it's looking better than it was, and certainly selected countries that are service-oriented, who've been able to diversify their economies. In other words, those countries that are not commodity dependent. Those are the countries, I think, that are seeing substantial growth. In fact, growth really hasn't altered dramatically downwards at all for the Kenyas and Rwandas and Ethiopias of this world. I mean, these are the economies, broadly speaking, not just from an African perspective, but from a global perspective, that have remained extremely competitive and some of the fastest growth rates anywhere in the world. So those investment-led economies are the ones clearly that I like going forward. However, of course, the broader African growth rate has been weighed down by the biggest economies on the continent, South Africa, Nigeria in particular, and they've distorted, in a sense, that overall GDP growth rate over the course of the last year, and this very sluggish recovery for both those big economies will still distort the overall African GDP growth going forward for this year. But even there is going to be some recovery for Nigeria. area. South Africa has come out of a two-quarter recession. And on the basis of that, I think we are going to see a return to positivity about the continent. And I do also believe that that sort of Africa rising scenario that we've been talking about, which has gone through something of a rocky road in the last 2 years, I think there will be renewed interest in the continent. And we are already seeing that in terms of very solid foreign direct investment coming into the continent.
David, urbanization is maybe one of the biggest things that everyone is talking about right now. If we're looking at 36% today, fast forward to 2030, maybe it's going to be north of a 56% urbanization rate on the continent. Tell me, is this being reflected on the hotel space?
No, there's still a very great shortage of hotel bedrooms across the continent. If you look at North America, there's an average of 4,500 branded bedrooms per million people. In sub-Saharan Africa, that's 76. There is a real shortfall in many areas. Now, I'm not saying that there would be a directly comparison person for person, the bedroom demand, but there is a lack of supply across most of the continent. What you need, though, is to make sure you're building the right thing in the right place. Once you've done that right, you should get some good returns based on the investment profile of a country. So we're seeing growth in hotel values in many countries. I think over the last 8 years, over 50% of all countries in sub-Saharan Africa have shown greater growth in hotel investments than any other property investment.
Right. I think I want to bring Amos into the conversation here, because if we were to look at East Africa, for this particular one, if the Americas, ultimately, for every million people, there are over 4,000 rooms for every million, right? Fast forward to East Africa, there's hardly 50 rooms per 1 million people. What are hoteliers like yourself, pioneers, trailblazers, like on your end, what can be done to actually hasten this process?
I think one of the things that we need to sort out is intra-Africa air connections. Right now, if you look at the global scene, Africa is only in charge of maybe 5 or 3% of the international global air traffic. Of course, the future looks very bright. They say by 2035 we should have 300 million Africans flying within Africa. Of course, first of all, Africans themselves must embrace Africa for anybody else to embrace Africa. If you look at travel trends across the world, domestic tourism normally for each country should account for at least 90% of the arrivals. If you look at China, 500 million Chinese move within China every year, and about 53 million foreigners come into China. So for Uganda, for Rwanda, for Kenya, for Tanzania, we need to see that. But also we need to see intra-region travel, because if you look at Kenya, Uganda, and Rwanda, specifically, we have harmonized our rates for going into attractions, going into national parks. I will pay the same as a Kenyan. If I'm Ugandan, I'll pay the same as a Rwandi. If I'm coming to Rwanda as a Rwandan, as a Ugandan. Now that is good, but at the same time, I think we need to find a way as East Africa working in promoting the region as one, because right now, Kenya and Rwanda have done extremely very well in terms of using their national carriers to leverage the numbers that are within the region. But we need to see countries like Uganda also coming out with national carriers. There is efforts for countries like Uganda to start, being known. There's a lot of marketing that's happened in the last 1 year. Since 1971, there's not been any PR firm hired by the government of Uganda to market its image anywhere. But they started last year. We did German, UK, and the US. And the results are massive. I am a business owner on a few safari lodges in national parks in Uganda, and I can see even the bookings for 2019 are much higher than I've ever gotten before.
Well, I think that's very interesting. You did mention, Mr. Silk, earlier on in your presentation that yes, there are good projections, but there is a caution here, and you do point at the wrong policy choice can just undo everything as it is. Are there any examples? Is there anything that you can actually point out and say maybe the wrong policy choice for this particular country can just outdo all the works?
Yes, indeed. I just want to make one point in terms of intra-African travel, which I think is important. Intra-African travel is going to be based either on a growing middle class on the continent for leisure travel, or it will be based on rising trade numbers, intra-African trade, between African countries. And the point I keep on making about Africa is that this intra-African occupancy rates that are really needed is going to be based to a degree on how much trade African countries are going to do with each other. And at the moment, we on this continent only trade up to 18% of our trade is intra-African trade, when compared with the EU, where 70% plus of their trade is within the EU, 50-60% plus of East Asian trade is within that particular region. So until such a time as Africa becomes a manufacturing center where finished products are indeed manufactured on this continent and traded between African countries, we will continue to be relatively sluggish on this intra-African aspect, which then feeds clearly into the hospitality industry as well. Just to answer your other question, yes, wrong policy choices abound, I must tell you, not just on the African continent, but elsewhere as well. And what concerns me, particularly in a resource-rich continent, is that there is a propensity or a trend towards what I call, and academics call, resource nationalism. The control of resources and the limitations indeed of ownership, question marks about tenure, question marks about private sector operations in these particular sectors. I mean, that really can, I think, upset investor confidence. So countries that are showing exceptional promise, and I highlight a country like Tanzania, for example, exceptional promise. There is a danger that if Tanzania resorts to more populist economic policies, i.e. resource nationalism, in the worst form, that can offset some of these great growth rates that even I project for Tanzania for the next number of years.
It's quite interesting because on one end you do hear someone saying, well, one president saying drain the swamp, and he's about to build walls, and wouldn't one argue that maybe that it's not a long time coming that we are seeing the likes of the same populist movements and nationalistic movements?
Yeah, no, I mean it's very difficult. You've got to have good quality transport links, inter-African travel to get people through to make it work. If you end up having someone, for example, decide that they're going to put the visa price up for corporate guests up to $500 rather than $50 as it was previously, it stops people coming across. If you decide that all of a sudden conferences have all got to be held in government-owned hotels, it means that investors in that country are starting to think that they're going to struggle to make money. So, you know, there's another example where countries have suddenly decided that freehold land is now going to be leasehold if you're no longer from that country. And they just changed the rules slightly halfway through, and it really does scare investors off. If I'm going to invest in a hotel, it's a long-term project. You know, I'm not going to get a payback over the first 20 years, quite frankly. I need to be able to do that if the hotel's going to stay in good condition. So I need to have the rights on the hotel for a long enough time to make it worth taking the risk.
Amos, I want to bring you on this one. What do you think of such policies? Because this is actually very fascinating for a person like yourself in the thick of things in Uganda.
Well, I think there must be a balance. I think for any country to have logical, nice investment, especially foreign coming into the country, a lot of the companies, foreign companies, are looking into a country that has more locals with stake in its own economy, because with our politics, for example, in Africa, which we must sort out, it is important to see that the locals themselves have stake in their country, because then it will guarantee a foreigner coming to invest in that country. So for now, I think we must find a way of making sure that the people within different African countries, Uganda, Kenya, Tanzania, go beyond just talk, but also invest in areas that are needed. And I can also see from this meeting, which is something which was really nice, many of the chains that are here tonight running entities that have locals as owners of the hotels, and that's a very good thing. But we need to see more in that regard, because when the locals, I can give you an example of Uganda. Before I joined the tourism industry in Uganda, there was no single Ugandan among the top 10. And it was very difficult for the foreigners working in Uganda to advocate, because it was difficult for them to open doors. For 10 years, it's what I've been doing. I've been advocating, I've been leading the guys, the group. I say, guys, let's go and teach our leaders about the value of tourism. And it's worked, because one, I'm Ugandan, I understand the mannerisms, but a lot of people who are coming to the country fear to interfere with the political lining. But I have a stake as a Ugandan, and because I have a stake, I must take on leadership. I must tell them, you know what, if you're doing the politics is wrong, if the noise that's coming out of politics is not right, it actually affects the nation. It affects business, and that's what we're trying to do.
Again, the argument is it's quite expensive. The heavy hitters here. If you're looking at the top 3 hotels that are here, top 4. You're looking at maybe north of $5 million to set up some of these. And now maybe another thing that was hinted upon is the cost of the money today, which is outrageously expensive. If LIBOR is just above 6%, benchmark rates across much of sub-Saharan Africa hovering just above 15%. I want to hear your thoughts on this one. Let me start with you, David.
Well, you asked the question earlier, what's delaying hotel development? Why is Africa lower than North America? One of the key reasons that stops hotel development is the cost of money and the availability of money. It's not good enough just to have a piece of land and think this will be a great project. You've got to be able to actually sell it to investors and sell it at a rate that works. So if you're going to get a joint venture partner to come in, you don't want to be giving away the whole of the development. You want it to work together. So you need to actually do the due diligence to make it make sense. And then you can go to a bank, and with your JV partner, perhaps you can get better rates than you could get locally. But the problem is a lot of hotels are built piece by piece, and they sit there and they haven't got a full plan together. So then they get to an investor, and the investor says, well, I'd like Hilton to run this, but the standard's not good enough for Hilton, so it's going to cost a lot of money to rejig it. So then all of a sudden, that option's gone. It's a case of, in my opinion, what you need to do is plan it carefully to start with, and then explore the finance options. And if you can get finance in, you're going to end up with a project that works.
Really sounds like a country we both know. Start the hotel, then leave it somewhere. Someone else tries to take it up, then it just stagnates in there. David, you were just about to top up on this particular one.
No, look, I think the cost of money is clearly critical. Everyone, certainly at this conference, has identified that as a major impediment. And I think we need to flag the issue of a global trend of rising interest rates in general. I've made the constant assertion about Africa's rise in the last decade, that part of that rise has been on the back of the global economic credit crunch and US and other Western investors looking for higher rates of return outside of the traditional Western markets. We are now faced with at least a moderate uptick in US interest rates, which could also extend perhaps even into Western Europe. And as a result of that, the question is how much more will this add to financing costs here on the continent? I am a little concerned, if I have to be honest, about the issue of financing going forward. And African economies themselves are now going to be forced into a very difficult decision-making process of whether to keep interest rates relatively competitive or themselves to raise interest rates over the course of the next number of months, creating less of a differential between this continent's returns and, for that matter, returns in major Western markets. So I think this is an issue that is going to become much more difficult, much more, and what's the way to get out of it? Ultimately, the way to get out of it is for governance in general across the continent to be a lot more attractive, a lot more accountable, a lot more transparent, and a lot more competitive, given these added constraints of global financing and interest rates. And I'm not sure, and I really do think that we need to really look forward, and I say look into the future, to a scenario where rising interest rates are a constraint, and what do we do about it? We don't go back into the same old ways of doing business, the same old doubts about tenure, ownership, all the regulatory environment that can become so burdensome on investors. We need to deregulate, for that matter, across the continent, and that to me is the way to compete and perhaps to inject some enthusiasm into the finance aspect of the industry.
But then again, David, maybe if I could just follow up on that one. Wouldn't one argue that there's a lot of over-reliance on the financing that is coming from outside? Because if you're to look at Ethiopia, just 2016 alone, Ethiopia's foreign direct investment was $3.2 billion US. That is more than the GDP of Burundi.
Well, that's correct, but I think given the facts that have been presented at this conference today, much of the financing for projects does seem to be domestically based, and much of it does seem to be based upon high net worth individuals who are looking to expand their own portfolios in a sense, or indeed produce additional revenue streams or income streams for themselves. In terms of the hospitality industry on the continent, it's not really just about foreign direct investment. There's very much a local component to that. And I think more and more African investors who see a brighter future for the continent are looking to keep their money here. And that aspect of it I really like, because ultimately if African investors want to keep their money here on this continent, rather than invest outside of the continent, as some of my South African investors like to go outside of South Africa, that really to me is an encouraging aspect. Our own investors must be happy with existing conditions to invest. Others will follow if that occurs.
Amos, I can see you nodding.
No, I think I agree entirely with him. I was recently having a chat with a big Swiss banker. It was last week. He happened to be in Uganda. And he was telling me, the amount of money that leaves Africa, in terms of going to invest abroad, is about $280 billion. And the amount of money that's coming into Africa in terms of investment and aid, all combined is $162 billion, which means that there's a lot of capital that is flowing out of Africa because of lack of trust by Africans themselves to invest in Africa. But two, there is a positive side to FDIs and a negative side to it. The positive side is that when the FDI comes with a bit of technology, comes with a bit of knowledge that can be shared among the African people. But at the same time, if you look at a country like Uganda where you can repatriate 100% of your profits and we're not given a condition to be able to invest a lot more money within the economy, you lose out if you don't own the banks, you don't own insurance, you don't own all construction. That's the key. But at the same time, yes, for Africans to be able to invest in Africa, that a number of things. One, leadership must be able to convince for example, the case of Uganda, you'll find a guy putting up a massive mall that will cost the guy maybe $50 million. And that mall, only the ground floor has clients. And yet, we have 10 national parks and 12 game reserves with less than 1,500 beds in that are needing rooms. But the trust, the guy is saying, I need something that I can be in charge of. But saying, if we get foreign knowledge in terms of management on the chains, and then you tell this guy was $50 million, and instead of putting into a mall, he's able to team up with a good management company to be able to run a profitable business, that would be a good one. But at the same time, government gets the taxes from the people. For the case of Uganda, I can see there is restating of Uganda Development Bank, which is specifically supposed to focus on Uganda's growth, and that should be able to give, if resourced, should be able to give Ugandans capital, seed capital that is much cheaper than the commercial banks, because the commercial banks are ridiculous, 30%. What is that you're going to do per year to get 30% from the business?
You've got to fund it through equity, basically. It's the only way it's going to go. In our brokerage team, we've seen there's been an awful lot of intra-African investment. So from different regions coming in, and taking the place of where traditional foreign investment was coming from. I'm saying that because it is still foreign investment, because it's coming from, say, Nigeria or Ghana, but it's still African investment. And there is an awful lot more confidence. And I think it's a sign of the governments almost getting closer together, that people feel that they are prepared to invest across the borders.
I just wanted you to top upon something, a very fascinating report that you did release this year, Africa Hotel Report 2017. And I think one thing that really stood out for me is 9 countries on the continent have no branded hotels. I don't know what to ask. There's like a million questions I could follow that with, but just walk us through this particular finding.
Typically the reason is it's either too difficult an investment climate, or it's going to be too expensive and the rate that they'll generate will not give you a return on the money that's invested. So typically I would like to see a good return on my hotel investment that's going to get me a payback in, say, 10 years if it's in an area I'm not so happy with. So if it's, say, Chad, which is one of the areas that has no branded hotels, you would need, you're a little bit more scared of your investment and you need the money out quicker, and it just doesn't produce that because there isn't the demand. You'd need to be generating something like $350 a night to be able to get those sort of returns out. And there just isn't the demand at that rate. You'd end up with 10% occupancies. So it's sort of, it's a catch-22. What we need to do is bring in a budget hotel there and be able to have that branded. But then most brands don't want to start with a budget hotel in a country. So it's difficult.
It is very difficult. I want to bring you in on this one, David. Massive opportunity. Of late, we're now seeing boutique hotels come in, still part of the report. But where does push comes to shove on this one, and maybe more investors come into this particular space?
Well, I think they're going to come in more in the middle market segment, and I think I have to be honest. I mean, for years I've been saying that and it may not be politically unpopular, but for years we've just seen far too many luxury rooms being built at the expense, in a sense, of that middle market segment, which really needs to expand. Now, the good news, certainly from the conference that we're attending here, is that just about every one of the branded hotel groups are now moving into that segment. Clearly, they've found that occupancy levels have either reached a plateau or in some cases have even disappointed at the luxury level. Given the tougher trading conditions on the continent for the last 2 years or so, and given the fact that the middle classes, this mushrooming middle class that we all talk about, I don't believe has reached quite those levels that were expected 3, 4, 5 years ago. It's a more modest incremental growth of the African middle class. The necessity for these middle market, middle segment hotels has become even more acute. So I think this is certainly something that I take back as highly encouraging from most of the branded hotel groups that I've encountered now. That's where the story is going to be going forward, I believe. Yes, there's room for the luxury segment, and there will be the luxury segment in certain markets, but clearly there is a necessity for affordable accommodation. And given the very nascent intra-Africa trade that I keep on talking about and harping on, that trade is going to be built around affordable travel opportunities, including, I might add, affordable airfares, perhaps a further deregulation, may it come, of the African airspace, and then also these more affordable hotel rooms that are coming on stream in the next few years.
In your view, do you see this as the beginning of the death for the luxury hotels, at least for much of sub-Saharan Africa? Amos?
I don't think so. I think that luxury group is there. A good example is Rwanda. Look at Sate, look at Singita coming in now. You have one and only one. And I run a business here. And so I can see the amount of interest from, especially agents from the US, Europe, wanting us to work with these luxury brands. Of course, there is a market. I'm not sure whether the market is within the cities. I think the market might be outside the cities, especially close to attractions, natural attractions. For the cities, I see a lot of interest, especially for Kampala. There's a lot of interest growing for boutique hotels. They are doing fantastic. They're making profits, those guys. And unfortunately, there are very few in the city. I realize that many of the travelers, yes, want to spend somewhere between $150 to $300 a night for a good room, but at the same time, they also don't want to have big, massive hotel. They're looking for 20 rooms, 30 rooms, smaller place, intimate, and that's the experiences guys are looking for. Of course, we're also going to have a bit of challenges as far as Airbnb. Those guys, they're taking over a market that is massive. People are turning their homes into accommodations, and I'm sure investors like this will tell you some stuff.
It's actually the next point I was going to touch with you, David. Airbnb, just moving into a particular space and just owning it. Like it's like they've been around for decades, and yes. It's innovation versus what we have come to know as the norm. Where do we draw that line?
Well, it's difficult because the market for an Airbnb isn't directly the same market that most hotels compete for. The problem with the hotel market is we're all competing for various segments to come in, and Airbnb shares a particular type which tends to be, on the whole, probably about 60% of their business is the more independent traveller that's coming in and just trying different things. What you were saying earlier, I don't believe that luxury hotels will die because there is always a market for them. The mid-market and the budget make more profit for their owners. So if you're after a financial return, you'll look for that. But what you've got to remember, most hotel investors, there's two different types. One are after a financial return, the other ones are after pride of ownership. That's why we have so many luxury hotels. It's possibly one of the best ways to show off your wealth. you can come and stay in my hotel. You're not showing off in any way, you're just doing a general invite, but you can show how rich you are. If I say come and see my office block, you don't know whether I've rented it or not, whereas the hotel, you know this is, I've done well. And it's something that a lot of my clients, they're not looking for a return on their investment, they're looking for something that's really special to say, look how beautiful it is.
But my argument might be that, if at all the average age of the African right now is 19.5 years, fast forward to 2050 when this 19-year-old is so many years old, and when he was starting out to travel, he used to get an Airbnb. Fast forward to a few years from now, won't there come a time whereby the Airbnbs are maybe hypothetically more popular than not to mention brands, but some brands that we have come to know but in a few years ago?
I've always found the best way of looking at what's likely to happen in the hotel market is to look in North America, because they're 20 odd years ahead of most other parts. So we see that there's demand for service departments which weren't around in different areas. We've now got new boutique hotels, we've now got an awful lot more independent hotels that are sort of luxury, but in all markets. And the branded hotel segment is perhaps less important. Where it is important, and I've done studies on this, is basically when it's a less mature market, people are confident with the brand and they're happy with it. They know they'll get their club sandwich, whatever. They know there'll be hot water in the shower, whereas an independent may not have it. But when you get to a market that's sort of evolved and it's established, maybe it's my 4th time to Kigali and I know it, so I'll go and stay in a nice boutique one because I know the city now, I'm not worried about it. Whereas my first trip to Lagos, perhaps I will stay in the Sheraton because I'm just a little worried. Fascinating.
Gentlemen, I know time is running very quick. Just before I let the three of you go, FX volatility. I'm going to shoot this one to both of you, Amos and David. FX volatility, we have seen a lot of depreciation and devaluation. South Africa, the Cairo, the pound too, and some people have gained, others not so much. And I don't know, where do you draw the line between the two? Maybe I could start with you, David, and throw it over to Amos after.
It's a complex question. If Africa had a better manufacturing sector, we would, as a continent, be able to take advantage of depreciating currencies. Our exports would be more attractive and more competitive globally. However, that manufacturing sector to me is still very nascent. It still hasn't really developed in any big way at all. And as a result, currency fluctuations indeed do very little to assist our economies except for some basic exports that some countries do have. It does, for example, help Kenya's flour industry for that matter. South Africa's wine industry it gets assistance from depreciating currencies. But there's not enough exports from the continent in order to make those foreign exchange fluctuations really help the continent. So I get quite concerned about depreciating currencies across the continent from a manufacturing or export point of view, because we just don't have enough to export. And I also get concerned because of the increasing levels of debt that so many African countries have really now positioned themselves in that particular negative space, raising bonds in dollar-denominated values. Very much so. Now, a lot of this state expenditure, these sort of developmental state economies that have done very, very well, the Ethiopias of this world, largely on really fairly heavy debt burdens as a result. Now, if those currencies tank, we are looking at pressure on those treasuries to repay those loans, and those pressures can really damage or at least retard the 7, 8 or 9% growth that we do project. So I have to say that I would much prefer a more stable exchange rate for the continent. And again, it comes back to the political analyst in me, which really talks about sentiment-driven economies that are attractive, largely speaking, to foreign investors, and foreign investors want certainty. They want as corrupt-free as environment as conceivably possible, and they want stable political governance and, for that matter, independent and accountable institutions. And I think those, to me, are always my fundamentals that I come back to, because if those are more or less in the right place, don't have to be perfect, but more or less in the right place, then I think all of these industries we talk about will grow and grow exponentially.
Amos, 2011, the Uganda shilling depreciating by, well, inflation skyrocketing to over 26%. Just give me a sense of the FX volatility, at least from your experience.
Now, I think he has a I think Africa, he has mentioned very good points. You see, the forex issue is about import-export, really. Now, Africa is consuming a lot more. And the only way we can handle this, if we want to consume, we must do import substitution. We must understand the products we're importing. If you look at, for example, Uganda, the trade between, on products, not services, the trade between Uganda and China, for example, we import products close to $1 billion from them. We earn less than $50 million from them as a country. Now, and this is continuous. It's not, we don't not have only the deficit with China, but we have deficit with so many other countries. So the governments must start thinking, what is that we're importing into our countries? Like, for example, the case of Uganda, what are we importing in? Can we do import substitution? Can we ask the locals to consume less? Can we produce more? And that's what we're talking about. Now, each country must be able to identify its niche. Asia, look at Asia. The reason why a small country like Thailand, for example, every small county has got a product it produces for the world market. Now, as Africans, so Uganda, every county in Uganda must start producing a product for the world market to be able to bring in the resources. We need to also take advantage of our potential in terms of natural resources. Africa has got over 50% of the world's arable land, but we're importing food worth $36 billion from outside Africa. That is inconceivable. Uganda has got 48.9% of East Africa's arable land. 85% of Uganda's land is arable and top quality soils. However, we still are importing fruits from South Africa. So why shouldn't we be, for example, saying we should be the production engine? Recently, the American ambassador to Uganda was saying, you guys have soils that can be able to feed 500 million people. So it goes back to governments. Governments must put in programs that can be able to encourage production in terms of manufacturing, but also at the same time taking advantage of our natural resources. The challenge with manufacturing is the cost of production. Cost of production in terms of electricity. For example, we as a country, any dam that we're building, the people that are coming to invest in first are not Ugandans, but they're putting 20% cash at hand. Then they're borrowing 80% in order to balance, in order to bring in enough money to construct an electricity, producing dam. Now, that way you're going to be held captive for so many years because these guys have to pay debt for a long time. They must make profits. So the cost of producing just a toilet paper in Uganda is much higher than the cost of producing a toilet paper in the West. However, this time around we're saying, you know what, Uganda is so beautiful. It's one of those places where you see the big 7, chimpanzee and the mountain gorillas added on the big 5. Then you see the Nile. Then you see Lake Victoria. Then you see the mountains. Now take advantage of that beauty. With tourism, you need very less. You can do a lot with renewable energy.
Right, gentlemen, I'm afraid that's all the time that we did have. Fascinating insights indeed. David Harper, CEO of Hotel Property Africa. Right next to him, we do have David Silk, Director for Political Futures Consulting, and last but not least, Amos Wekesa, founder of Great Lake Safaris. That's where we'll leave it for this particular CNBC Africa special.